Hi, everyone. Welcome to Terra Stories Impact Investing Series. In this series, we explore impact-focused public and private companies in multiple market sectors that utilize proven, cost-effective, and game-changing sustainable technologies to reduce costs and increase efficiencies and shareholder value. I'm Gary Brode of Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge fund managers, portfolio managers, and family offices. I'm very excited today to welcome our guest, Vicki Benjamin of Karner Blue. By way of introduction, Karner Blue runs a series of funds focused on the environment and biodiversity. This is Vicki's passion, her area of expertise. Every interview that Vicki's done before focuses on those ESG aspects of the investments. Today, we want to talk to Vicki Benjamin, the stock picker. Before I do that, I just want to point out two things that I think are really impressive and very important. One is that Vicki lives a life of great integrity. Her passion is the environment, her passion is biodiversity, and she's put together a business that's focused on that. And we think that's incredible. The second thing is I've been told I cannot use the words market beating returns, but they've turned out, let's just say competitive returns. You can look them up yourself, Karner Blue Capital, LLC. But they've turned out great returns while limiting themselves to the subset of the world that meets their environmental criteria. And that it's hard enough in this business to turn out good returns. Vicki and Karner Blue are doing it with a limited subset of the universe. And that also, just for a degree of difficulty alone, deserves applause. Vicki, thanks so much for taking the time. Thrilled to be talking to you today.
Me too, Gary. Thank you very much for this opportunity to discuss Karner Blue Capital and our innovative investment approach.
Terrific. So why don't we jump right in? I know you're on record so many times as an environmentalist and a specialist in biodiversity, but let's talk about some of the great things you guys have done on the stock picking side, some of your favorite stories. I know when we did the pre-interview a couple days ago, you were talking to me about mining companies and how certain companies have gotten in and out of the portfolio. I'd love to know more about the decision-making process behind that and how you're making money in that sector.
Great, thank you. So let me just step back one moment and talk about the Karner Blue investment hypothesis. We believe that biodiversity risks are fairly opaque to investors. Companies, stakeholders don't really disclose a lot about their impacts. Investors traditionally have not asked about these impacts, and so therefore companies have not provided information. Without that information regarding biodiversity impacts and dependencies by companies, ESG data providers are not able to take data, comb data using AI, package ESG vendor solutions to be applied into investment management products. So Karner Blue Capital, we recognized almost 5 years ago that the planet is facing environmental crises, right? We have climate change, and shortly on its heels, and almost close to magnitude, biodiversity loss. So recognizing there's not a lot of reporting by companies on their dependencies and their impacts, we knew that we had to do a bottom-up research approach to evaluate those dependencies on biodiversity integral to company operations. So therefore, when you talk about restricting our universe, we start out with our index, the Morningstar Developed Market Index, and only focus on those industries that have impacts relative to biodiversity. And again, with the hypothesis that since companies aren't reporting those, that there's an opportunity for outperformance for investors by Karner Blue Capital doing the research and peeling back the onion on those companies and evaluating those, looking for outperformance for those that are best able to manage those risks, which we believed to be material to their operations. And just 2 quick points. Those risks are more than just environmental, Gary. Think about the recent pandemic. That pandemic is due to wildlife-human conflict, whether it be in a wet market or in a logging road or a road being constructed for mining. There's a lot of interaction between wildlife now, increasingly more, while we're deforesting and changing land use. And now with the administration change, there's a lot of companies, and you're seeing it too, that are facing a lot of governance risk related to changing regulations, the Green New Deal, the infrastructure project, a potential carbon tax. These are going to have major impacts on companies that not only have climate-facing risks, but also biodiversity risk. So we have narrowed down our universe to those companies that we believe have these risks, and we're able to add value through our research process and stock picking. So let me move a little bit forward onto our stock picking. So once we've narrowed down our universe and have evaluated our biodiversity leaders out of those 16 industries of impact using proprietary models on that academic research piece, our fundamental financial team takes over and says, I have a universe of a little under 300 companies from 7,000. How do I evaluate those? And that's the question you're asking me. Well, my portfolio manager loves to say, Vicki, you gave us a tailwind. You've picked the companies that are best able to manage these risks, environmentally based. And we think those companies already have a lead, as they have great management. They recognize they have a dependency and impacts that are probably going to come to fruition and affect their operational and financial productivity in the next couple of years, or the investing horizon of 1 or 2 years. So we have a good universe here, but how do we select the best of the best? The first thing we do is we do an in-depth controversy assessment. We evaluate on 3 criteria: the severity of the risk, whether it's social, environmental, or governance, how the company mitigated it, and how long ago it was. And then we do something fairly unusual. We measure those risks, those controversies, against others in their industry. So there are some industries that are mired in environmental risks, social risks, like textiles and apparel has a child labor problem. Mining has environmental issues, dam breakages, for instance, or indigenous people licensure issues. So we do further, while we're evaluating it for stock picking, we look at historical controversies, and this is important, 5 years back. We then step back and say, let's look at these industries, these 16 industries, and what are the trends? And we score the entire industry, all participants in the industry. And I want to pause here for a moment. It's not just those leaders in biodiversity that we score. We score the entire industry, whether it's illiquid, has an ADR, does not have an ADR, or is a biodiversity underperformer. It's fundamental to Karner Blue's methodology of evaluating stock performance, whether it be biodiversity or financial, to look at everyone in the industry, because it's the best way to benchmark, is to look at the entire population. So while we're evaluating, we're gonna focus in on one industry, metals and mining, for instance. We'll look at growth of all the industry participants. So for instance, operating income growth, OIG, revenue growth. Then we'll look at profitability, return on equity, return on investment, and then valuation. And in metals and mining, you're usually looking at, you can look at both PE or PB. And then we also do another consistent look at the balance sheet strength, right? The quick ratio, the current ratio, and debt to total capital. And then one other thing we also look at in evaluating these companies and these industries, take for instance, metals and mining, is their dividend yield, which we add to their overall economic health, which includes the metrics I just spoke of, along with any earnings surprises. Because one thing we found is that when companies have positive earnings surprises, usually management tends to have a underestimate bias, and they'll tend to have another earnings surprise. Everyone likes a good earnings surprise. So once we've done that, we know that we have leaders in this industry. And one of those companies, and again, focusing on metals and mining, is Fortescue. And Fortescue is a biodiversity leader. They have set aside lands for biodiversity preservation. And in the metals and mining industry, they are a iron ore extractor, and they have superior performance in site management. So what that means is they evaluate the site before, do a biodiversity species count during looking at an interruption, and then after, to make sure that the disruption and that they've maintained the biodiversity species density. So Fortescue passed through all of our metrics. And for instance, they are a leader in their PE. The industry mean in metals and mining for price earnings is about 11. And PE for Fortescue is about 7. So they're a value to buy. They're also a leader in price to book and sales growth. Their sales last year, over 3 years, were 20% versus an industry average of 5%.
I'm sorry, what was 20% versus 5%?
3-year sales growth versus the industry average of 5%.
Gotcha. Go ahead. Sorry. So
their operating income growth also an impressive 32% versus an industry average of 4.4. So we evaluate companies on an industry level, within the industry level, and then once we have selected the leaders by quartile in industries, and remember, we have 16 industries of impact, we move all of those leaders over against each other. So we have a fruit basket of apples, oranges, bananas, grapes, all different industries. And this is where the real stock picking talent comes in. But before I continue looking at the individual companies within this fruit basket, do you have any questions about our industry analysis or how our biodiversity whittling down process?
No, I think you've gone through that in great detail. Clearly, it's something you've discussed before. Fortescue that you mentioned, you said they do a lot of environmental study, both before and after they do their mining. How does that affect their margins?
How does that affect their margins? Well, I mean, it's the extractive industry, that's somewhat of a diagnostic test, correct?
Right.
Both ways. And we've been working with, and I'm not exactly sure that some of the mining companies use satellite imagery. We've been working with another company that's doing DNA testing. So it's called Bioethics, and they can actually do this for mining companies. They go take, and a shout out to Bioethics, they'll go take a soil sample or a water sample. It's completely fascinating, and I'll go off on a tangent here, but they can actually count the species that have been in that water. And they did this for the pink-nosed dolphin a couple of years ago for an NGO, not another NGO, an NGO, to see where the density of the population was and along a river. And so they can take just one vial of water, and they can count the number of species that have been in that water and the density of the population. And they can do the same on a metals and mining site. So it's not that expensive to test species diversification. And you also, what you look at metals and mining is one of the key things that we've been engaging on is their emergency plans, right? So if there's a disaster, a tailings break, that's another one of our key performance indicators is what are their emergency protocols to deal with that, to avoid, first of all, human loss, but then ecosystem loss, rivers, water sources, and soil erosion.
So it sounds like in order to make an investment, you need to have a detailed conversation with operating management regarding some of these factors.
That is a key component. Much like every financial firm, right, Gary? You always have to call the underlying companies and you establish a rapport with them. What's a little bit different about Karner Blue Capital is often we have two different sets of people calling, right? We have our biodiversity experts calling, asking about environmental protocols and the species that are interrupted through these extractive activities. And then we have our financial team calling about questions about what does the future look like? What makes their margins so much better than their competitors? And where is their differentiation? And what do they see going on in the future? So Karner Blue, I can say, we have a different process, although similar to others. But there's a lot of company contact.
Got it. Okay. So I know earlier you talked about a situation last year where you put a particular mining company in the portfolio and then took them out, replaced them with a different one. Let's talk about that process. How'd you make that decision? What got the companies in, out, and how'd you do the valuation work?
Okay. So when I mentioned, when you're dealing with what we call scope 1 companies, we how it's a little bit different way of thinking about greenhouse gas emissions from CDP, where they have scope 1, scope 2, scope 3. We have scope 1, scope 2, scope 3 for biodiversity impacts. So when you're dealing with scope 1 industries, which are extractive industries or industries that actually touch and change land use and animal habitats. So extractive industries, oil and gas, metals and mining, agriculture, paper and forest, textiles and apparel. Scope 1 industries that actually have feet on the ground. You have a lot of environmental controversies, and you have a lot of also social licensure issues with indigenous people. So Rio Tinto is probably arguably, if it's not the largest, one of the largest metals and mining companies in the world. And we were impressed by Rio Tinto because, for one reason, specific to animals, was that they were the only metals and mining company that we had spoken with that had poaching laws and policies and bushmeat policies, which is a very complicated issue. But when you look at the drivers of biodiversity loss, which include exploitation, then having those kind of policies when you're dealing with very biodiverse rich areas, especially in consideration of wildlife, it's admirable that companies have policies and they've come out and asked that employees don't engage in these kind of activities. So it was unfortunate when Rio Tinto had an issue with the indigenous people in Australia and disrupted a burial ground. And it was we're seeing more and more of this, and it was something that we consider indigenous people synonymous with biodiversity. They protect 25% of terrestrial space on the earth. They're the best protectors of biodiversity that we have, and took it very seriously and removed them from the portfolio. And they're remediating, they're working with the community, but they'll be evaluated later, but we took them out of the portfolio. They're arguably a controversial company, but a lot of times you'll find, Gary, that controversies, the larger a company, of course, the more the controversies, right? But we look at these controversies with a much heavier hand.
Okay, makes sense. One of the other issues that we were talking about a bit is lithium mining. And I know there are a lot of people on the environmental side very excited about the possibilities of battery electric vehicles. And they often talk about them as zero emission vehicles, which is not entirely true. It's zero emission tailpipe. But the amount of lithium that needs to be mined and the environmental impact of that is often not considered when people talk about the environmental value of electric cars. And I think part of the reason for that is because they don't see the lithium mine where they drive the car. Any thoughts on that? What's the future of lithium mining look like? Do we have enough lithium? How destructive is that for the environment? Are these costs being evaluated correctly by the people who advocate for electric vehicles?
So you're asking all of metals and mining is a messy process. And when we look at we kind of jumped right into stock picking, but when we look at companies and their impacts and industries and their impacts, we look at the 5 drivers of biodiversity loss. And I'm going to get to the answer to your question. So we look at, and we are a biodiversity focused firm, right? So we look at the 5 drivers, which are exploitation of the animals, which we just talked about. And that's mostly wild animals is what you're talking about when you're talking about exploitation. Habitat destruction, pollution, climate change, and invasive species introduction. So each of these industries, more or less, affects one of these very materially. So a lot of people look at land use for metals and mining as being the key indicator. It really isn't, because they only affect about, I believe it's less than 10% of the land. Maybe it's 1% of the land. I knew this off the top of my head a minute ago, and it's good. And then what we really look at is their water usage, the tendency for controversy related to wholesale environmental destruction if there's a tail dam break, and we look at indigenous people rights. And when you look at lithium, you can see that the water price of lithium, it's 500,000 gallons of water is needed almost per metric ton of lithium. And lithium and cobalt are precious minerals, and much of the lithium reserves are found in South America, which we all know is a heavily biodiverse region. And all of the, as we have talked about, there's a lot of social issues surrounding the mining of precious minerals, and not just the environmental issues of the disruption there, but also the child labor issues and the indigenous people rights issues. There's a lot of infringement. We know that a lot of the lithium companies right now, lithium is also located in South America and China, and there's some in Australia. I believe that we believe that lithium, as far as looking at carbon emissions, because climate change contributes between 11 and 16% of biodiversity loss, that fixing the climate change issue is key right now, compared to you can put in appropriate safeguards for lithium extraction. That's it. And like I said, we are not investing in a lithium company because they fail many of our other ESG criteria. That said, it's very exciting. There is an alternative. There's a significantly greener source of lithium that is currently being researched and tested, and we're sitting anxiously looking at that, and that's geothermal brine. And that's extracting lithium from highly concentrated brine. And it's a new technology. There's not a lot out about it, but what we have been searching for when you and I first spoke, I said we look at companies of impact that have biodiversity dependencies and or impacts, and metals and mining has a biodiversity impacts, you're always looking for solutions to those impacts. And those involve mitigating the impacts or finding alternatives. So I think with the lithium issue, you're looking for metals and mining companies that have responsible policies over lithium. Many of them are just traditional around normal mining processes, environmental protection processes, social licensure protections. And then you're looking for those companies that operate responsibly. And then you're looking at those companies that are developing alternatives, because climate change is coming, and electric car technology, electric truck technology is key to doing that. We need to reduce our carbon emissions. You'll agree that the automobile industry, the transportation industry, is responsible for, I believe it's around 35 to 40%, if you count 1, 2, and 3 scopes of our GHG emissions. So I think that is the immediate risk. And we can implement responsible metals and mining extractive techniques to mitigate some of the risks around lithium and cobalt. Long answer to a short question, but there's a lot of considerations around. You're asking me a very large question, whether the cost benefit of mining lithium with all of its destruction and extractive issues is more important than what it does, what electric batteries will do for carbon change, for carbon elimination of carbon emissions. And I think right now the immediate risk is higher than that we can mitigate that with better operating protocols.
So I think you made a really interesting point here. Usually when people talk about cost benefit trade-off, they're talking about right now, these are the costs and benefits of path A, the costs and benefits of path B. What you're really doing is you're talking about over time. Instead of just right now, here are the costs and benefits of each path. What you're really saying is there are certain issues that you think need to be dealt with immediately, and then other ones we can deal with them well, but also down the road. And that's I think a very interesting perspective in terms of prioritizing the issues that you want to be dealing with.
And it goes back to your stock picking. So we believe our quality at a reasonable price is our mantra. So we have a value slant. And that said, and we have a 1 to 2 year investment horizon. But new technologies like lithium alternative mining, Tesla, Beyond Meat, those are high growth stocks, right? They don't have a 1 to 2 year investment horizon.
Right. If you're paying that price right now, you better be.
Well, they're in our fund, because their benefit to society and the environment as a whole is so poignant and provocative that we always say to ourselves, and it's a new way of thinking, is I usually have a 1 to 2 year investment horizon, and that's for those companies that are minimizing their impacts in their traditional businesses, minimizing their dependencies. But then I have these companies that are inventing, these companies that have got a whole new innovation, and maybe we're not going to recognize their value in 1 to 2 years. They're on a 10-year value investment horizon. And so you've actually diversified your risk a little bit because you've moved down the investment horizon. But who would we be if we did not invest in these technologies that give us alternatives to current operating protocols? They'll actually allow us to either A, minimize climate change. I believe climate change is going to happen, right? It'll be much better if it's 2 degrees than something else. And so we need to manage that immediacy and invest in these new technologies and these alternatives. And so that's that's why our strategy is a little bit different, and there's a little bit give and take between the biodiversity folks and the fundamental financial research folks who say, I've got a 1 to 2 here. And we're like, yeah, but we gotta stop biodiversity loss now and try to help with climate change. Because fixing climate change is not enough to help with the biodiversity loss.
Well, Vicki, thank you so much for a fascinating discussion. I know we always try to limit these to about 30 minutes so people can have lunch while they're watching. What a fascinating conversation. For people who want to get in touch, we're speaking with Vicki Benjamin of Karner Blue Capital. You can find her. If you can't find her, and I don't know why you wouldn't be able to, either contact me, Gary Brode at Deep Knowledge Investing, or take a look at Terra Group and they'll put you in touch directly. I want to thank all of you for joining us, and you can view more of our series at www.terra.bz/impact. And thanks so much for your time today.
Thanks, Gary. Thanks, everyone.